Hello tradeologists, and welcome to Module 11. In Module 11 we're going to talk about advanced techniques and explosive wealth building strategies. And these are the strategies that if you have a little bit more capital, you can put that capital to use really productively. I'm going to show you a couple of methods that are, just explosive strategies. They really are the way to create wealth in the market, and if you really want to make a killing in the market, this is exactly how the big players do it, and you're not going to find a better strategy than this. Now we're going to talk about a couple of different things. There's some basic strategies that I want to go over, and then we're going to talk about adjusting those strategies just like we did with the option strategies and the monthly income strategies. But this particular module on advanced techniques and wealth building is going to be on stocks. Now, can we substitute stocks and use options instead of stocks? We're going to talk about that a little bit as well. We're going to talk about strategies to not only protect your investments but also benefit from those those strategies of protecting your investments. How to pick stocks. And then we're going to get into a couple of advanced strategies that I really find helpful for the times when you're not really sure if you want to buy stocks or if you want to sell stocks or what you want to do in the market. There's a lot of uncertainty in the market at times, and you don't know if you should be jumping into stocks or not jumping into stocks and so forth. So we're going to talk about a couple of those strategies. But first I want to talk to you, the very first strategy I want to talk to you about is a method that turned a $14,000 trade into $75,000 in profits in about 8 months. And there's a couple, and that particular strategy was some time ago. There's a couple of strategies that I did recently on a couple of different stocks that produced very, very good returns. And once again, this particular strategy does not depend on the stock going up. The stock can actually go up or down. I'm going to show you two examples of stocks that had actually gone in an upward direction, and then I'm going to show you an example of a stock that went in a downward direction and was still able to make money. The key here is to understand the management of risk. Just like we did with monthly income trades, management of risk is everything in the market. You can't have a free lunch in the market. There's just no such thing. Nobody's going to give you a dime. Nobody's going to help you with anything. No one is going to give you a penny that you have not earned. And if you understand that, and then you understand the fact that you have to manage your risk, and also that adjustments are probably going to be necessary. Active management of your trades is a key requirement. Now, your monthly income trades, yeah, you could probably let those go for a while, a review of those every 15 minutes or so, and you'll be fine. The same thing goes for these trades, only there's a couple of different parameters that you really need to take a look at. There's a couple of things that really would trigger your additional action. And we'll kind of go through those. I'm going to set up the basic strategy for you, and then we're going to go into the advanced strategies, and I'm going to try to layer those as we go along so that one piece of knowledge that you have builds upon the next piece of knowledge, so that when you end this particular module, you have all of the pieces together in a coherent whole that you can kind of take with you as you study the market and try to pick stocks that you're interested in purchasing. Now, why do we do stocks instead of options? Well, let me go through the basic strategy, and I think the reason that we do stocks over options in this particular strategy is going to become evident. Number one is these are a little bit longer term trades. I mean, on a very basic level, a lot of times these trades will last a month, 2 months, 3 months, sometimes as much as 8 months or more. And in those cases, sometimes you can't find those long-term options. You can do leaps, but they still have the downside is that they're going to expire at some time in the future. If you buy a stock, it's not going to expire in the future. So the very basic strategy that we're going to start with is actually the purchase of stock. Now, right now I have on the screen a chart of Starbucks going back about 5 years on a daily basis. As you can see, I mean, Starbucks had a tremendous run up here, and then in late 2006 it got into trouble, and it dropped from a high of about $40 a share all the way down to 15 and a half just recently. Now, that's a pretty steep decline for this stock. And if you go back, I mean, to a number of different types of stocks, you'll see the zigzag pattern of, a nice run up in the stock, and then, a little bit of a sell-off here. I mean, this is a pretty steep sell-off alone, just going from around 39 down to 28 or so. I mean, that is a pretty bad decline. However, as it climbed back up, and let's take the guy who bought it right here at 40. I mean, right here, right at the tip of that little candlestick right there. Somebody sold it, and somebody bought it right at 40. If you can just kind of take a look at that. Let me draw an oval around that. Right there. Imagine being the buyer of that at 40. That doesn't look good, does it? That stock immediately, the person who bought that at 40 immediately the next day woke up and saw it trading at 37.5 all the way down to 36.5. That's a pretty steep decline for the first day of trading after you bought that stock. Now, would he have any indication that it would probably trade that low? Not really. I mean, if you look at volume, if you take a look at volume, if you have any, I mean, if there's technical analysis involved in the picking of stocks, you would have looked at an increase in volume over this period of time here, this little run up. It wasn't huge, but at least on the day that you bought it, it was huge. There were a lot of people who bought that stock at 40. You would have had no indication that maybe that stock was going to open up dramatically lower the next day. You would have gotten crushed. Now, generally, I go in and I buy 1,000 shares at a time of the stock that I want. Now, you could go in and buy 100 shares, or 200 shares, or 300 shares, or 400 shares. The strategy that I'm going to talk about, you really can't do for less than 100 shares. You need to buy at least 100 shares of the stock. So 100 shares of Starbucks at $40 would have cost you approximately $4,000. Now, on margin, that means putting up about $2,000. In margin. So you've got 100 shares of stock at $40. The next morning you wake up and it's trading around 37. You just lost $100 a share, $3 a share for each $3 for each share that you purchase. So you just lost $300. If you bought 1,000 shares, you would have lost about $3,000. So that's not a very particularly attractive thing to have happen. I mean, if people who bought down here, they're pretty happy. They bought around $29. Now they're up around 40. But there's not very many people that can actually pick tops or bottoms of stocks. Any time that you buy a stock, and it doesn't matter what the price is or what the former chart history looks like, I don't care where you bought it, you're taking a risk. If you just go out and buy the stock and you have absolutely no way of hedging that position, protecting your position, you just go out and buy stock. Now, a lot of people say, oh, yeah, buy stock, and it's a great strategy if you want to increase your wealth. But you know what? You have to be terribly lucky. Now, here's another instance right here. People bought this stock at 32. There were people, I'm sure, that bought right there. Maybe a lot of people. And look what happened over the period of the next month. It dropped from 32 down to 24. Now, it never got back up to there. I mean, well, it did get back up to there, but I mean, it had a little bit of a rally here. It came up to 27.5. But, eventually, I mean, if you waited long enough, you would have gotten your money back up here, which was in December. If you bought this back at the end of 2005, and you're waiting for that stock to get back up to where you bought it, you would have had to wait almost a year just to break even.